guys, it's Stock Curry, and the markets are starting to do things that we have not seen since the last bear market / recession. Today we've got to talk about the VXX Short Squeeze, the Fed meeting on Wednesday, and what I traded to make a 50% profit. So let's get into it! Let's start by talking about something rare that happened on Tuesday, because this is historic, and it's a major warning sign for investors. There is a product that measures the volatility in the S&P 500. That product is called the VIX, or VIX. VIX is a calculation that is listed as an index even though there are no actual securities in the product. It's just a mathematical calculation based upon a number of factors. The gist behind the VIX is that it rises when the S&P falls and it falls when the S&P rises. For a long time now, there was no way to trade the actual VIX, so futures products were created to match the VIX instead. Then, later on, exchange-traded notes, or ETNs, started buying short-term VIX futures. These ETNs were listed on the stock exchange, and regular people could buy them and sell them just like any other stock or ETF. Some of the popular VIX ETNs you may have heard of include VXX, UVXY, and VIXY. The downside to these ETNs, though, is that because they trade short-term futures contracts, the cost of maintaining the ETNs is very high, and the fees eat into the value of the ETNs over time. As a result, the value of these ETNs drops significantly over time. You can see that here with UVXY, how it started trading at the equivalent of $1 billion and today trades for only $20. Now, every ETN has a real value, also known as a notional value, indicative value, or net asset value. The notional value is tied to the value of the underlying futures the ETN holds. Because the ETN trades on the stock market, it's possible that a large number of buyers can cause the price of the ETN to rise well above its notional value. It's also possible that a large number of sellers can cause the price of the ETN to fall well below its notional value. So to keep the price of the ETN tied to the notional value of the underlying futures contracts as much as possible, large banks buy and sell shares to keep the trading price of the ETN in line with the notional or indicative value. But if, for some reason, large banks stopped buying shares, say because new shares were no longer issued and large banks were unable to buy shares, then it's possible for the price of the ETN to rise well above its notional value because banks can't increase the number of shares outstanding to push the price back down. And that's exactly what happened on Tuesday. Barclays suspended the issuing of new shares on VXX. When that news came out, a few savvy investment banks who understood how VXX trades started buying VXX shares. Others started buying large amounts of call options. That in turn caused retail traders to buy VXX shares and call options as they saw the price running up. As the price rose higher and higher, the market makers who issued those call options were forced to buy shares in what is known as a gamma squeeze. That in turn caused the price to rise even higher. As all of this was happening, automatic circuit breakers got triggered. Circuit breakers stop securities from trading when the price rises or falls too fast in a short period of time. Circuit breakers are designed to give people time to fix algo trading errors, retract false news stories, and fix other human errors that cause stocks to rise or fall faster than they should. When the circuit breakers started getting triggered, that caught the attention of Fidelity and a few other brokers as well. That's because what happened on Tuesday was very similar to two situations that occurred in 2008 and again in 2018. In 2008, Lehman Brothers made risky bets on the market that went against them, and that ultimately caused them to go out of business. The collapse of Lehman Brothers triggered a massive sell-off in stocks towards the end of 2008. In 2018, extreme volatility caused VIX to double in price overnight. That caused XIV, which was an inverse VIX ETN, to drop over 85% overnight. Retail investors lost a massive amount of money as a result of that drop. After that happened, Fidelity and others switched to position close only to protect retail traders from blowing up their accounts again. Credit Suisse and others actually removed their VIX products from the market altogether. This news story on the screen right now is from 2018. So when VXX jumped after Barclays suspended issuing new shares on Tuesday, Fidelity and others did the exact same thing they had done in 2018. They suspended the buying of new shares on VXX and switched to position close only. They did that to protect retail traders who might have been buying VXX Tuesday morning, not realizing it was well above its notional value. Once the buying pressure was stopped by a combination of circuit breakers and brokers switching to position close only, VXX quickly fell back down to its notional value. Well, almost. It's actually still quite a bit above its notional value, but there's a good chance it will get back down to its notional value over the next few days. So that's what happened. Some of the rise in price may have been due to short sellers covering, but it wasn't really a short squeeze. It was really just Barclays deciding it was no longer going to maintain the notional value of VXX, and that caused a lot of people to buy call options on VXX. As the price of VXX rose, that in turn triggered a gamma squeeze. So it was a gamma squeeze that caused VXX to rise up well above its notional value on Tuesday. What's interesting to me is that what happened on Tuesday has not happened since 2018, and prior to that, it hasn't happened since 2008. During both of those periods, 2008 and 2018, we were in both a bear market and a recession. We already know we're in a bear market right now, and the price action on VXX today is a major warning sign that the markets will continue lower and that a recession is on the way. Later on in this video, I'm going to give you more proof of that. Now, in other news, commodity prices continue to fall. That is good for the markets because it means inflation is slowing down, and it's one of the reasons the markets were up so much today. But that is also bad for oil and gas stocks because they continue to fall as the price of oil drops. In the Discord, we've been playing CVX put options, and a lot of people in the Discord sold those put options for anywhere from a 50 to 70% profit on Tuesday. Another person closed an IMPP put option for a 188% profit on Tuesday. If you want to make money like this as the markets are going down, come join us in the VIP Discord. As a VIP Discord member, you will get access to all of my trade alerts before the trades are filled so that you can join in on these trades also. I will also coach you and help you become successful and profitable during this bear market. You can make money as the markets go down. I'm doing it, the people in the Discord are doing it, and you can do it too. If you want to start making money like this, then join the VIP Discord at stockcurry.vip/getvip. Even if you've never traded options before, I will teach you and show you how to become profitable in the VIP Discord. So come join us at stockcurry.vip/getvip. Okay, now moving on to the big news that will move the markets on Wednesday. The Fed will end its two-day meeting on Wednesday, and they are largely expected to raise interest rates by 25 basis points or 0.25%. This will be the first rate hike since 2018. Now, a 25 basis point rate hike is already priced in. If the Fed deviates from that at all, that could cause the markets to go down. If the Fed does a 50 basis point rate hike, for example, or if the Fed combines the 25 basis point rate hike with the selling of bond assets, that could cause the markets to fall on Wednesday. We should know what the Fed is going to do shortly after the market opens at around 10 a.m. Eastern Time. Then, at 2 p.m. Eastern Time, Jerome Powell will give a press conference. That's when we'll find out what the Fed plans to do for the remainder of this year. Expect the markets to move massively between 2 p.m. and 4 p.m. Eastern. Which direction the markets move, though, is anybody's guess. There are some zero-day options expiring on Wednesday on QQQ, which is a NASDAQ 100 ETF. QQQ will be the most price sensitive to Jerome Powell's comments. So if you want to day trade the speech, I would day trade the zero-day options on QQQ. The options are pricing in a 1% move in either direction, and there's a good chance QQQ will move more than 1% up or down when Jerome Powell starts speaking at 2 p.m. Eastern. There's also a good chance the options will be significantly cheaper at 2 p.m. since they will have lost so much value from time decay. I like the idea of opening a straddle on QQQ shortly before Jerome Powell starts speaking. A straddle is an option strategy where you buy both a call option and a put option. This strategy is effective when you expect a major move in the market, but you're not sure which direction the market will move. To open a straddle, you simply buy a call option and a put option at the same strike price for the same expiration date. I wouldn't open this as a straddle though. I would buy the call option and put option separately. That way you can close whichever one is in the wrong direction and keep the one that is moving in the right direction. If you open the straddle as a multi-leg option strategy, you might be forced to close them both together, depending upon how your broker works. So I would open them separately. The other thing I would say about this is to only do it if you are experienced with both day trading and trading options. While this strategy can be very profitable, it is also very risky. It is so risky, in fact, that many day traders refuse to trade zero-day options because the risk of losing everything is too great. But if you are a risk taker, this strategy can provide a huge profit. Just keep in mind that you could also lose your entire investment within minutes if the market flips while Jerome Powell is speaking. So understand the risks before attempting this strategy and only use money that you can afford to lose. Okay, the last thing I want to leave you with is some technical analysis on the S&P 500. The S&P 500 has now formed a death cross on the monthly chart, and that's got people talking. A death cross is a technical indicator that points to continued downward momentum for some time to come. The last time the S&P formed a death cross was during the recession and market crash in March of 2020, and the time before that was during the recession and bear market of 2018. So this has technical traders worried. Based upon the technicals, the S&P will fall down to either the 50-month EMA or the 100-month EMA before bottoming out. Those levels represent a fall from all-time highs of 27% and 39% respectively. It should be noted that during the dot-com bubble in 2000, the S&P fell down to the 200-month EMA, and in 2008, the S&P fell well below the 300-month EMA. Those levels represent falls of 52% and 59% from all-time highs. So far, the S&P has only fallen 14% from all-time highs. So technical traders are worried that the S&P will fall much further from here. Alright, I hope you enjoyed that video and got a lot out of it. Comment down below how you're playing the Fed meeting on Wednesday. And I wanted to let you know that Webull is offering their best promotion ever this month. If you're looking for another broker, I always recommend having more than one. I've got 5 of them. Then you can sign up for Webull using my link in the description below. When you do that and deposit just $1, Webull's going to send you 5 free stocks worth up to $9,600. They're also going to give you $5 in free crypto when you make your first crypto trade. So if you want to get 5 free stocks worth up to $9,600, you can sign up for Webull using my link in the description below. Just make sure you deposit at least $1 before the end of this month. Now, if you're not a U.S. resident or if you're looking to trade OTC penny stocks, then I recommend Interactive Brokers. Interactive Brokers is a highly discounted trading platform. Trades start at just $1 US, $1 Canadian dollar, 4 euros, or 6 Australian dollars, depending upon where you live. Interactive Brokers also offers single-leg and multi-leg option strategies, and both Webull and Interactive Brokers have the full pre-market and after-hours trading from 4 a.m. until 8 p.m. Eastern Time. Now, I do want to remind you that I have material connections with both of those, so whenever you sign up for either one, not only are you getting a great broker to trade with, you're also helping me to continue to produce these great videos for you. Now, finally, I want to remind you to hit that like button, subscribe, and if you're on YouTube, click the bell icon and click all so that you can get notified when I release my next video. I hope you have a lot of success trading, and I will see you tomorrow.